the last few months have been quite rewarding in the financial markets, and we think there is good reason for that. If we look at the economic data, both in real terms and the inflation data, we're seeing a weakening in the economy, much weaker inflation, both lower than expected, and the Fed is beginning to change its tune.
Bitcoin tends to have these moments where it goes up sharper than anybody thinks, and it goes down sharper than anybody thinks. And so when you have such an inflexible supply, when you have such tightly held supply, when a lot of it's not even on exchanges, even a lot of the coins on exchanges are from people that are not even actively trading. They just leave some of their coins there. And so the amount that's pretty liquid is actually not that big. And so when a significant amount of capital wants to come in, that can move the price very quickly. And I track a couple things. I mean, obviously the ETF news is probably being constructive towards it, the upcoming halving. But another thing I track is that Bitcoin price correlates very heavily with global liquidity, and it's just been a long bear market. A lot of the coins have rotated towards very strong hands, and so it only takes a small amount of new demand to move the price pretty disproportionately.
All right, so here we go. Fiscal policy. This is, again, the federal budget deficit as a percent of GDP. It is very high by historical standards, meaning the deficit, the more negative, the higher the deficit. And we now have a new Speaker of the House who has to navigate a very difficult situation between Democrats and Republicans. But one thing I believe will not happen, and that is big spending programs, even though we're going into an election year. Very often in an election year, spending programs pop up all over the place because it's an election year. And representatives, senators, others want to give their constituencies good news. I don't think that's going to happen this time. And I think, in fact, we'll probably see surprising spending restraint. So I think if we're right, what will happen is spending restraint, but the economy softens. So it'll probably stay in this range for a while until we enter a recovery. So let's move on then to monetary policy. So money supply started falling in July of 22 on a sequential basis. Since then, it has dropped 5%. Now, on a year-over-year basis, it's down roughly 3.5%. And you can see maybe it's ticking up a little bit, but that's only because we're now comparing against declines a year ago. So the so-called comparisons are getting easier. So very weak monetary supply statistics, and we're seeing the monetary base has dropped from, I think it was $8.5 trillion at the peak, to now about $7.7 trillion. So real shrinkage out there. Now, I've talked about velocity before. What has offset this decline and kept GDP growth moving up in the last year? It is this chart, velocity. The velocity of money has been moving up. And it's a cyclical move. So you can see the velocity of money, as measured by M2, peaked in 1997 and has been in a downtrend ever since. That typically isn't the case when real estate, industrials, and financials are the best performing categories. Worst were energy. It was the only negative sector, consumer staples, and healthcare. So those last two are more defensive categories. That does make sense in the context of how innovation-based strategies like ours performed. So it's been a great rebound from the lows in October, just a massive rebound, and has transformed the year for a lot of asset managers, either for the better or for the worse. And if we're right, and inflation is going to surprise on the low side of expectations, and growth disappoints, we'll be in a period where innovation does its best. Innovation solves problems. If you need to protect your margins as your pricing power disappears, then you need productivity-enhancing technology. And with the breakthroughs in artificial intelligence, and we marvel all the time about the breakthroughs in AI as AI training costs drop 70% per year. There's a boom out there, and that is what happens when prices drop. And prices associated with disruptive new technologies always fall. So it's a perfect environment for our companies to thrive. And I'll close right now by featuring two pieces we've put out recently. Both of them, interestingly, are on Bitcoin as we get ready for hopefully the SEC's approval of a spot Bitcoin ETF. We think it is going to happen. There are all kinds of signals that it's going to happen. So in a timely way, we put out our Bitcoin monthly in the last week. Check out the health of the Bitcoin network and the ecosystem broadly in that piece. And then we just released our latest Bitcoin brainstorm, which we are in partnership with the Bitcoin Park in Nashville, Tennessee. And those are opportunities for us to showcase the developers out there.
The reverse repo facility, the way to think of that is that basically represents excess demand for T-bills. And so what the Fed does not want is for there to be so much demand for T-bills that it pushes T-bill yields below the lower end of their target short-term interest rates. And so they have this release valve where money can instead go into a reverse repo facility and get yields that are similar to T-bills. They hold it at that level to make sure that basically there's no reason for T-bills to go below the reverse repo facility rate by any significant degree, and that's part of their kind of tightening process. And when the Treasury issues a ton of T-bills, that money can come out of reverse repo and into T-bills. So reverse repo is one of those things where, in a healthy market environment, there really shouldn't even be a reverse repo facility. Right now, it's just kind of this excess pocket of liquidity that was built up during the stimulus, and now it's kind of coming back out. And so it's kind of counteracting the Fed QT. The reason it's relevant is because after it runs out, um, if the Fed continues doing quantitative tightening, that'll be starting to come out of bank reserves. It'll start to kind of kind of reduce liquidity in the core banking system, and therefore increase the odds of some sort of liquidity accident. Which if it shows up in the Treasury market, you'd probably have the Fed come in and stop QT. A similar thing happened back in 2019 with the repo rate spike. It wasn't some gigantic event for normal people. I mean, basically, it's one of those like quiet crises that most people don't know of. But if anyone who was like following macro or banking at the time was like watching this with interest, because you had kind of an interbank overnight lending rate just completely blow out, and the Federal Reserve, in addition to addressing that market, had to come in and start buying treasuries again. Because that was kind of the core problem. There was a treasury oversupply problem. And going back to the prior point of soft landing versus hard landing, I've been using the term emerging market landing, because when you look at like recessions in emerging markets, they look pretty different than we see in developed countries. You know um, you have an environment where you have kind of recession-like conditions, but asset prices in local currency terms are still doing okay, because the local currency is pretty running, often very large deficits, is often inflationary. Um, and so you get these weird dichotomies where it's like a hot recession. right? It's like an inflationary recession, a stagflationary recession, and so asset prices and things like that are not doing great in dollar terms or gold terms or things like that, but they're doing okay in local currency terms because local currency is having a problem too. And those types of recessions only come up rarely in developed countries. We had it back in the 70s. We arguably have it right now, and we had it back in like the 40s. And those are kind of the instances where this pops up. We also see there's a very big divergence between fiscal and monetary. So monetary, like Federal Reserve, Jerome Powell, they're trying to be relatively tight. They're trying to hold rates at a high level. They're trying to reduce their balance sheet. It's largely coming out of reverse repo. On the other hand, the government, Congress, president, and all these groups, they're running very, very large fiscal deficits. And it's not even just now, it's accumulated from decades past. So a lot of it is just interest expense is completely blowing out, ironically, because the Federal Reserve is trying to tighten. And fiscal deficits, all else being equal, are stimulatory and inflationary. So we have this kind of weird economy, which is that if you're primarily reliant on short-term financing or a lot of financing, you're probably in trouble. You're already probably in a recession, or at least your industry is. And if you're not, and if you're on the right side of deficits, if you're the military-industrial complex, if you're kind of in your own, if you're on the right side of all this interest expense, then you're doing okay. And so I think that's why the economy is kind of feeling very odd to people because it's we have a larger gap than normal between fiscal policy and monetary policy, and so that results in kind of very bifurcated economy and very bifurcated markets.